Hey everyone, it's Jeff Wild. I just want to do another video and show you how you could have used my market reversal levels over this past trading week to make some nice profits. Now, I just want to go over a few things for those of you who have never been exposed to this before. These are actually reversal or turning point levels that I post on my blog. I post them on the weekend, and then they are good for the following 5 trading days, Monday through Friday. So in this particular case, I'm going to go over an example on the Euro Japanese yen on a 30-minute chart. And this is a trade that you could have taken back on the 14th. And I'll also go over a few other setups as well. One thing I want to point out, I'm always asked, well, how do I come up with these turning point up and turning point down levels? And I'm asked, are they based on the standard floor trader pivots? And the answer is no. Okay, I look at a lot of things. I will look at Fibonacci retracement levels, Fibonacci target levels. I will look at some Elliott wave patterns. I will look at key numbers in the market, in other words, big numbers. I will look at previous support and resistance levels. I will look at previous congestion levels. I also look at candlesticks. In other words, you can tell a lot by looking at the nature of candlestick. In other words, if you see a lot of sideways action with candlesticks with small bodies and a lot of wicks, okay, that tells me something. So there's a whole lot of things that I put together, and this is just stuff I picked up over the last 19 years in the markets, and they help me determine what I feel are the most prominent turning points in the market for the upcoming week. And one thing I want to say is that when you see my levels, I only post 7 levels, or sorry, actually 6 levels, and they're pretty far apart. And the reason being is I want more significant levels. Sometimes you'll see people that post their turning point levels, but they're every 15, 20 pips away, and to me, there's no skill in that. If you put your levels every 15, 20 pips, you're bound to hit something, all right? It's not that hard to do. To me, the trick is to get the more significant levels where we're going to get the bigger bounce. Anyway, with that said, let's look at the Euro Japanese Yen 30-minute chart. Now keep in mind that my black lines are my area. It's called a turning point down level. My red is where I expect it to be a turning point up. So basically, one of the key patterns I like to look at is when the market gets within 30 pips or closer to my level, I'm going to start looking for setups. And one of my favorites is I want to see a divergent setup, okay, between the indicators and the price activity. And I know this is old hat for a lot of you, but just let me go over this. Basically what I'm doing is I'm looking at the swing lows, okay, and I want to see that the indicators, and it doesn't matter whether I use the MACD, which is in the middle here, or the stochastics, but I want them to be making higher lows. So in other words, the market's making lower lows, but the indicators are going up. Same thing. Now I realize here, if you look at that swing low, this is a lower swing low, but overall, this is going up, so that's okay. And one little thing I want to share with you guys and gals, let me just take this off. This is to me, a much more important clue that the market could make a reversal. When you see a swing high and then a lower swing high, all right, the indicators should be making lower swing highs. But notice this made a very strong swing high compared to that one. That is a high probability that this divergence setup is going to stick and have a reversal point in the market. So keep an eye out for that. All right. So anyway, I like to look for the divergence setup. Then I'm looking for some kind of trigger bar. It can be a doji. Now let me just blow this up a little bit more so you can really see the candle patterns. Okay, it's a little too much here. All right. So I know it doesn't look like quite the same picture, but I just want you to see the bars for a minute. So if it gets near my line, in other words, we have a divergence setup, then I'm looking for an entry bar. It could be a doji, which is here. Or I also like an inside bar, which is in here. In other words, this bar is within the length of the previous bar. And then we will just simply buy the breakout of the high of that, okay? Now, this is textbook. It doesn't always happen like this. I wish it would, but you can see that the whole idea is that when the market is really running, it's going to go from one level to another. All right, so it basically ran up 200 pips from our entry. And then the idea is when you get to the turning point down level, you're looking for a reason to go short. Now, I want to see a divergence sell setup when I get here. So in other words, I'm looking at the swing highs. One swing high is slightly higher swing high. Notice MACD going down. That's an indicator to sell. All right. Then I also need to find a reason on the candlesticks. Let me blow this up again. We're looking in this area. Okay, sorry, back here. There was an inside bar, we go short. Now this thing only ran down maybe 23 pips and then eventually it went back up. Okay, it was still testing this resistance area. Now one thing I want to point out is for me, money management is more important than anything. So if I'm up 20 pips or so, I'm really going to tighten up my stop. I wouldn't want to let that thing run all the way back up and take out my stop, which would have been up in this level here. If I'm up 20 pips, I'm going to move my stop either to break even or maybe so I wouldn't lose more than 5 pips, okay? Just, you know, to me, one of the cardinal rules in trading is you don't let a winner turn into a loser. Now, notice that the market made a slightly higher high again in this area, but yet still MACD still diverging down. You could take another short. And this is a inverted hammer up here. You could go short off the low, okay? Or if you look here, eyeballing it, it might be an inside bar. I can't quite tell. I'd have to do a measurement, but it's very close. But anyway, you can go short off of here. This is another situation. It might run down 25 pips. It comes back up. Same thing. I'm going to tighten up my stop. I wouldn't want to wait to get stopped out, okay? Now, let me just go over one other setup for you. You can see that eventually what happens is areas that are resistance, if you start trading strongly above, they will become support. So resistance becomes support. And here you had a classic setup. Market comes back down. I love resistance turns to support. Notice we had an inside bar here. You can go long, all right? And then one other little tip or trick that I use that I've never shared in over a couple of years is because these levels are far apart, sometimes I'll basically divide them in half. You know, you can eyeball it. Okay, it's about like that. Notice I am dividing between this level and this one. So let's say the market's climbing up. It's making new swing highs, but I see that the indicators are diverging down. I may take a shot and anticipate riding it back to my support level. Okay, that's just a little tip that I haven't talked about, and it's something I will talk about more in the future. And then one last thing. In this example, I've been talking about or using a 10-minute chart, or sorry, a 30-minute chart. You can also use a 60 or a 15. Let me just take this off. If I do a 1 hour, you know, we got the same type of situation. We have an inside bar down the bottom here. One swing low, another swing low. Notice that the indicators are starting to slant up. Also, you can see that little thing I was talking about where you have a higher swing high here. So anyway, that's it. I highly urge you to tune into my blog each week at AskJeffWeld.com. This is all free, nothing to buy. So that's it. Hope you all have a great weekend and a profitable week.